if you look at the standard, right, India standard, they talk about fair value of a derivative as having included costs like credit and liquidity costs. Now, what does it mean? Now, internationally, credit costs are very well recognized. Right. In India, not all companies do, but some auditors do insist. Credit costs do play a role. Rather, the credit cost has been recognized in the accounts. So this credit cost is what is called CVA. CVA means credit valuation adjustment. Now, what does it mean? What do you mean by this? Now, there's a lot of technical stuff. Please, you can ignore all this. I'll explain it in a very layman kind of a term. Let's say you, or rather two counterparties A and B are dealing with each other. The question you can ask is, if I am doing a derivative, let's say forward or a swap or anything, A does a derivative with B, right? And B does it with A. Now, when this trade happens, what is the fair value of this trade? That's a question that the auditors are asking, right? Now, the answer is the fair value of the trade can be looked at as some sort of, I would say, is it just a replacement value? Well, the answer is yes. In a way, it is replacement value. But if I take this further and ask a simple question, if I have A has done a deal with B and there is some chance of that the B will default, right? Now, for A, is the fair value of the derivative just the simple mark to market as per the current market, or mark to market, right, subtracted for the potential loss that I can suffer due to the credit, potential cost of credit, meaning potential, as of now, if I can somehow hedge myself from the potential for B to default, right, then that cost of hedging also should be part of my valuation logically, which means to say, therefore, if a counterparty A does a deal with counterparty B, in A's accounts, the value of that trade cannot be simply the mark to market value, which is nothing but the MTM that you see in the market. It should also include the cost of hedging that potential exposure that this particular entity has to the other counterparty. Right. So this is what is called CVA. Now the question is, therefore, how do you do it? Now this is the way the $1 million question is for the Indian market, right? Now, logically speaking, CVA is simply the credit valuation adjustment. The name itself literally tells you that you're adjusting the value of the derivative for accounting to account for the credit cost, right? So how do you do it? Well, logically speaking, if A is doing a deal with B, I will simply look at what is my exposure that I have on B, and then what is on that exposure, what is the probability that the B will default, and if B defaults, how much of that exposure is lost. So it's simply exposure times probability of default times loss if the default happens. So loss given default. So this is the standard way of looking at it, right? CVA is calculated like this. But then the problem is, what is the exposure? Well, this is where the issue comes. In India versus globally. So Indian auditors, what they simply, a lot of auditors, they're okay with this, saying that right now you might have some exposure or you might not have an exposure, right? When do you don't have an exposure? Let's say A is you, B is the bank, right? When don't you have an exposure? Well, when your mark to market is negative, that means you owe the money to the bank, then you don't have exposure on the bank. But in future, it can come to you, right? Well, markets can turn around quickly, and then what is negative MTM right now can become positive MTM for you, which means you will have potentially have an exposure to the bank, right? So CVA therefore attempts to model exposure and calculate what is the future potential exposure for this potential future exposure, and then calculate on that exposure what is the probability of default and loss given default, and derive at the CVA valuation.